Hey everyone, today we're going to be talking about how stocks make money by using this cute little guy. So keep watching and I'll explain. Okay, so yes, you are wondering why there's a cute little burrito in this video about how stocks make money, and that is because we are going to be talking about how stocks make money using the world's best Tex-Mex restaurant, Chipotle. And of course, Chipotle sells these beautiful little burritos here, so that's what we're going to be using as our example. And before we start, I want to give you a disclaimer, and that is that I am not recommending Chipotle. I'm not telling you to buy it. I'm not telling you to sell it if you own it. I'm just saying that's what we're using. It's for educational purposes, okay? So that's out of the way. So most of you who are watching this video, I'm sure have one question in mind, and that's not exactly how stocks make money, it's how do you make money by investing in stocks. And what's interesting is that it's all kind of lumped together. The way that you make money is the way that stocks make money. So let's talk about the two ways that someone who owns a stock can make money. Okay, so the first way that you can make money with stocks is via dividends. So dividends are pretty easy to understand. So if you own, let's say, $100 worth of stock. So let's say a stock costs $100, and you own $100 of stock, so you own one share of stock. And let's say for every share of stock, the company is gonna pay you $5. So that means you're gonna get $5 for every $100 of stock. So if you own $1,000 of stock, that means you own 10 shares of stock, which means that you're gonna get $50 instead of $5. So for every share of stock, you'll get a certain amount of money. There's another way that these companies can pay dividends, and it's via paying you additional shares. So let's say you own 1,000 shares of stock and the company's gonna pay a 5% dividend. Well, they're gonna give you an additional 50 shares of stock. So there's two ways to make money in dividends. It's either through being paid as cash, so literal cash that goes into your brokerage account, or it's by additional shares. Now these are both worth money because if they give you additional shares, you now have extra money because you could sell those shares. Or if you have the cash that the company pays in cash instead of shares, then you literally have cash you can do whatever you want with. So those are two ways that you can make money with dividends. And so let's go to the next one, which is capital appreciation. So capital appreciation is also pretty self-explanatory. So for example, let's say you buy a stock that's worth $100 and you hold that stock, and a year from now, that stock is now worth $110. So it's trading on the stock market for $110. That means that you can go ahead, and if you want to sell your share of stock, you can go and sell it on the stock market and someone else will buy it for $110 if that's the price it's selling for. And in this situation, you would have made a 10% return, or you would have made $10. You bought it for 100, you sold it for 110, there you go, you made 10 bucks. This is capital appreciation. So those are the two ways that you can make money in stocks. You can either buy a stock and be paid a dividend, and or you can buy a stock and sell it for a higher price in the future. The thing is, understanding what a dividend is, I think, is pretty easy. You buy a stock and it pays you money. But I don't think a lot of people understand why someone might own a stock that doesn't pay a dividend. As in, some people think that the only reason you should buy a stock is because it pays you a dividend. You want that income. And the thing is, it's all interconnected and intertwined, and to really understand why you would buy a stock that doesn't pay a dividend, we need to understand what a stock really is in the first place. And perhaps one of the best ways that you can see that you're really an owner of a company when you are a shareholder of a stock is through the fact that you get voting rights. So some of the voting rights that you might get as an investor could be whether or not a stock should split, whether or not a merger and an acquisition should happen, whether or not you want a board director to be elected to the board. So there's all these different ways that you can vote on what happens in the company. And think about it. There's 350 million people in the United States of America, and we all think it's a very important thing to vote because we are part of the country and it's part of democracy. And if you own a piece of stock, you get to vote as well. you get to be a part owner of the company. So voting is a very important part of being a stock owner. And again, so if you own one share of Microsoft, yes, you get to vote one time. Will it make a difference? Well, I think voting is important, so it's something that you should always remember, that it is ownership of a business. That's what a stock is. Now that we know that stocks are ownership shares of businesses, we know that you can make money via dividends and capital appreciation, we can now talk about the world's best Tex-Mex restaurant, Chipotle. The reason I picked Chipotle for this example isn't just because they have delicious burritos that are amazing and I love them and everyone loves them and they're just, the most magical things on earth. That's not the reason. But they are, but that's not the reason. So the reason I picked this is because Chipotle doesn't pay a dividend. And so I wanted you to understand why a company that doesn't pay a dividend may still be purchased by an investor. Let's talk about how Chipotle makes money. Of course, Chipotle owns stores, and those stores sell food. And so this is where our cute little burrito comes in. If we look at one store of Chipotle, we know that the store has overhead. You know that it has to pay employees, it has to pay rent, or it has to own the building. It has costs of goods sold, the ingredients that go into selling the food that you buy there. So at the end of the day, when I give money to Chipotle for my delicious burrito, that money that they receive goes back into the company. And as long as the store sells enough items, and those items make a profit, this specific store will be profitable. So now we want to understand that a Chipotle as a restaurant should on average be a profitable restaurant. And so Chipotle probably knows how much profit on average a restaurant that they open will make. And so where do the profits go? Well, the profits go back up to the top of the company and they're distributed. So since Chipotle has over 2,500 restaurants, and because on average those restaurants are profitable, profits that were made from selling these little cute burritos now go back into the company. And so what they need to do is decide whether or not the money that they're making should all be reinvested into the company to open new Chipotle stores, or if some of the profits that they've received should instead go to stockholders in the form of dividends. And so let's understand what would happen if Chipotle decides to, instead of opening new stores, they decide to pay a dividend to the investors. So let's say Chipotle decides that they're gonna take 10% of their profits out of the company and they're gonna pay it to shareholders. So if Chipotle decides to pay 10% of its profits to its shareholders, this means that the stock price of Chipotle will fall by the percentage of the dividend of the stock price. Now, why does the stock price fall when a dividend is paid? It's because the company just gave 10% of its profits to shareholders and now it doesn't have that money anymore. Because management has the other option of, instead of paying a dividend, they retain the money. And what happens if Chipotle can retain the money? They can buy more stores. So for example, in 2017, Chipotle opened 183 new stores. In 2018, Chipotle opened 137 new stores. And in 2019, Chipotle opened 140 new stores. Today, the company has 2,622 stores. Now think, if on average, each of these stores brings Chipotle some profits, and Chipotle can take the money that they make and open new stores, will it not increase their profits in the future? And the answer is yes, it will. But if Chipotle pays a dividend suddenly, they don't have as much money to open as many stores. And so in 2019, because Chipotle opened 140 new stores, what if they pay a dividend and in 2020, they can open only 120 new stores? What happens is this affects the earnings or the profit of the company, because the market may be assuming that Chipotle is going to continue opening enough stores and operating efficiently enough to generate healthy earnings and profits. And the 10% dividend, if it's paid this year, may also be paid next year. So that means Chipotle next year may also not open as many stores. And this could happen for many, many years down the road. And so if Chipotle is able to invest the profits back into the company and expand operations to the point where the company is generating large gains in their earnings or their profits, stocks likely over time should grow as earnings grow. Which brings us to the fact that earnings are what drive the share prices of stock. Which is why when companies release earnings, if they beat estimates, they oftentimes will have a large gain in their stock price. This is because the market reacts to the fact that the company should now be worth more money because they made more money in earnings, which are profits. And also why when a company does not beat expectations, their stock price often falls. Again, because the market assumed that the company would be making more money. And because it's now not making more money, the stock price falls. So hopefully now you see that everything is interconnected. If a company can pay a dividend, that can be a great thing because a company paying a dividend can give money to a shareholder in the form of cash or additional shares. However, if a company could have reinvested that money and expanded operations, that may have been better because the company may have been able to grow its stock price at a higher rate than the fact that it paid out a dividend. So if you're able to invest in companies that pay dividends and those companies should be paying dividends, that could be a great thing. You'll have cash deposited into your account or additional shares, and that will help you make money. Also, some companies that pay dividends may also grow via capital appreciation. So if a company increases in value via its stock price, that could also be a great thing too, and you can sell your stock for a higher price in the future. You can also buy growth stocks, kind of like Chipotle, that don't pay dividends, but that you think will increase their stock price going forward because they will be able to increase their earnings over time. Okay, so hopefully you got some value out of this video and now you understand how stocks make money. Now, if you like the video, please hit that like button. It really helps me with the algorithm. It's great for YouTube and it really helps my channel. And if you want more videos like this, if you like things like this, please hit subscribe. Also, don't forget to hit that little bell notification. It will send the videos to your app or wherever it is that you receive notifications from YouTube whenever I post a video. So that's all we have for today. Thanks for watching and we'll see you next time.